What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is March 10th of 2025. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we've got to talk about how the alarm bells are sounding off when it comes to Bitcoin's price action. Not only was the recent Crypto Strategic Reserve Summit a big letdown across people's expectations in the market, but we are seeing the signs in Bitcoin's price, as well as altcoins, and in the broader macro trend in stocks and other assets that are starting to signal a major Q1 correction, something we've been talking about for a good amount here over the last couple of weeks. So I want to talk about how we can best prepare for it, why we're seeing this in price, and outside of that as well, where we could start to maybe find some good risk entry opportunities in the market. We got a lot to unpack. If you happen to enjoy this video, consider dropping a like, grab a cup of coffee, stick with me here. I'm a little bit sick today, guys, but if you enjoy the video, dropping a like is a great way to support it. So let's go ahead and kick things off here. First off, since back here at $109,000 back in January 2025, when we had a fake out and attempt to break past the previous highs, which was faded immediately and unable to be retested, we have since then seen the inconsistency at the 21-day moving average starting to turn into resistance. For those who may be watching not every single video on our channel, the 21-day moving average is this green and yellow line here, the 21-day SMA and EMA. This usually serves as a buoy of support as price extends higher and higher during uptrends. And when it starts to act as a point of resistance, this is usually where people start to take profit or losses from higher entries and essentially establishes the beginning of a downtrend. And we can see how the weakness at the 100-day and the 200-day now is a clear sign that we are not finding people accumulating at these typical points where we have buy the dip opportunities. To put it in perspective, from just a percentage decline standpoint, from 109 down here into the 200-day moving average, we had an entry opportunity of a 23 to 25% discount. And right now, we are not seeing buyers taking that, meaning that there is a clear difference here. This is just me telling you how it is, guys. There's no way to kind of dodge around it. Maybe things will change over the next couple days as we move a bit lower. But right now, after a 25% discount, there's still more market sellers than market buyers. And that is just a clear reality here. It's why price is playing out the way it is. This isn't manipulation. At the end of the day, there are more people willing to sell at the best available price than those who are willing to buy. Now, why is this happening here? Is it the market being overly dramatic and overreactive? You know, that's subjective. We could talk about that all day. But I have to tell you guys, I think it's clear to say at this point that we've had the ETF here for a while. This was really kind of the big catalyst for what you would say is probably this cycle or this uptrend in markets. It has been a big upset. There was a lot of inflows originally. However, as we'll talk about later on in those ETF inflows, we've started to see clear ETF outflows over the past couple of months. In fact, so much so that we are practically back where we were back here at the end of 2024. So an entire quarter where we've actually had neutral inflows here into the ETFs. And that's considering here we had a big inflow here, about 50,000 in January, but have since then seen nearly 2 months here, coming up on a month and a half here, that we have been outflowing on these ETFs with no serious signs of coming back. So we need to look for inflows elsewhere. And I think that's what people are looking for with the recent establishment of a strategic Bitcoin reserve, or SBR, as a part of the U.S. digital asset stockpile. This was the big meeting that went on back a couple of days ago. Everyone was really goosed up about it. But what came out of this? Well, essentially a few things. Some broad, vague statements. But most importantly, the thing was that essentially the United States government would essentially keep its over 200,000 Bitcoin that it currently owns from seizures and criminal activity that people had engaged in prior in the earlier days of Bitcoin, from exchange hacks as well as the Silk Road. But beyond this, they were talking about being able to potentially add Bitcoin. This got people really excited. But there's an important detail in the fine print here. And that is that essentially they are allowed under the Secretaries of Treasury and Commerce to authorize the development of budget neutral strategies for acquiring additional Bitcoin. Now, some people may gloss right over this detail here because they just see buying or acquiring additional Bitcoin. But if you don't read the fine print that this may impose no incremental costs on American taxpayers and has to be budget neutral, then you might start to miss the real details here of what this is stating. what this is basically stated is that the United States government can only go about acquiring Bitcoin, at least according to its commitment. Maybe this changes down the line, but this was the big announcement where the Trump administration got to come forward and present its idea. And what they basically stated is that they can only acquire Bitcoin through the sale of other government assets. So this could be, for example, bonds that it may hold, gold that it holds. I would even go maybe as far as to say maybe government real estate, right? Maybe some of the commercial real estate that the government owns. Who knows, right? It could really extend out towards a couple different types of asset classes. However, they've made it very clear here that in their commitment, this is not going to come at the cost of taxpayers, meaning that they're not going to be printing large sums of money through bonds, essentially U.S. treasuries, to go out and acquire large sums of Bitcoin like I think a lot of people had intended for. So when we consider this means that while, yes, this is great that the U.S. government isn't going to sell its Bitcoin, it's not going to add to the sell side pressure. A lot of people were expecting, and I think rightfully so, with the way it was being presented, that the government was going to be the next line of buy-side support here, that they wanted to essentially circumvent and pass the ownership of China, which is roughly about the same as the United States, to make sure that the U.S. was the crypto capital of the world. That's not what we got. And even carrying it forward into altcoins as well, we saw the tweet or the post from Truth Social about XRP and Solana and all these other cryptos being added. I think that completely got pushed by the wayside, with the criticism that came out from that, right? As we rightfully talked about here on this channel. And you can see through the market has completely reversed those gains. It looked like it was a total pump and dump, kind of quick distribution scheme for a lot of insiders. And now Bitcoin is back below the 200-day. And this is going down probably at a minimum over the next couple of days down here towards the prior relative highs here in March of 2024. We'll see if some buyers come in at that range because they clearly aren't coming in at the moving averages, right? But beyond that, the real max pain scenario, and it doesn't have to happen overnight, it doesn't have to happen in a straight line, is coming down to that 200-week moving average. And I'm going to tell you guys what scenario might really lead to that here. We've seen a major reduction in the accumulation of Bitcoin from MicroStrategy. Now, of course, still this quarter, in Q1, was the second largest amount of Bitcoin they've ever acquired. I'll give it that. Want to make that detail clear. That's definitely not the worst case scenario. But if you consider the momentum reduction here, right, as we move higher, we need more and more Bitcoin to be acquired. We need those ETFs to be inflowing with new capital to purchase more Bitcoin via the IBIT ETF and all the other ones. We need MicroStrategy buying more and more Bitcoin as the price goes higher, because as price moves higher, long-term held supply starts to unload onto the market, sell-side pressure picks up, and you need more euphoria, more buy-side pressure in order to maintain those higher prices. Well, we've seen the ETF outflows playing out, so that's not good. And we're also seeing the Bitcoin acquisitions, the momentum here, dropping sharply here from 77.4% in Q1 down here towards 11.5%, right? So this is coming down from that blow-off top here in MicroStrategy. But here's the really important detail here. So MicroStrategy isn't acquiring at the rate it was before, but this is another big inflow spigot here when it comes to Bitcoin, right? So the ETFs aren't impressive right now. They're outflows. MicroStrategy slowed down dramatically since back in Q4, which really led to the price acceleration we saw. The government is not really buying Bitcoin in any major meaningful way. But here's another thing we got to talk about. We talk about MicroStrategy so much here in this channel, I think everyone else does generally, about being this really big net positive for the crypto space. But there's a really important thing to understand here, and this is all public data. You can go to mstr-tracker.com. It's a free public tool that you can research and look at all the details for MicroStrategy. But here's something that really stands out to me. Because of all the major buying that MicroStrategy has done, just forcefully going out and buying Bitcoin, not waiting for buy the dip opportunity, their unrealized profit is still massive. It's $7.8 billion, right? So not giving them a hard time for that. Still a great trade overall. But their cost basis has increased substantially. So essentially, they've only made so far on their entire Bitcoin purchase, embarking on this really high-risk strategy of going all in on Bitcoin, making this big wildcard bet. Since back in 2020, over 5 years now, they have only made a 23.6% return. Meaning that if Bitcoin retraces this small net gain overall over the next couple of months, right? Like even 15, 20%, this starts to put MicroStrategy back in neutral territory. And another important detail is their convertible debt. $9.2 billion here. Now, of course, the annual interest rate is nothing really to worry about here. I don't think they have any financing issues. What I do worry about is that unrealized profit being lower than their convertible debt. And along with that as well, the value of their unrealized profit and loss moving lower and lower and potentially into negative territory. My main point here, guys, is that if MicroStrategy starts to get in the hole, that's going to be an even bigger problem than the question of whether or not anyone's going to be willing to take on new convertible notes for MicroStrategy. Right? We saw that that was essentially the way MicroStrategy acquired all this Bitcoin, up to 2% of the supply now that will ever exist in Bitcoin. Right? So this is a very important thing to keep in mind here, the potential sell side pressure this can invoke on Bitcoin, the de-risking the MicroStrategy might embark in, seeing as the US government's not going to come in and just buy up all the Bitcoin, right? We need to see whether or not MicroStrategy is going to start adjusting its strategy, no pun intended. Again, maybe that doesn't happen. MicroStrategy might be in a position, maybe I've got it wrong, where it can ride it out, even with its convertible debt, the convertible notes, right, and this debt, maybe it's not even a problem. But at the end of the day, if MicroStrategy can't get investors and bond markets to essentially take on new convertible notes, if the ETF outflows continue to play out, and it's not just Grayscale, but all of the major ETFs, broadly speaking, and we also don't see the US government coming and buying it, who else is going to buy? Like, I know some people point to El Salvador still slowly accumulating. That's not going to be enough. What we need is a big, sizable buyer, and we're just not finding it here at these prices. Maybe that happens down here at 50,000. Maybe that happens at 75K. But I gotta tell you guys, it's not presenting itself in price right now. It's not looking good. Now, this is just kind of the Bitcoin analysis here, and these are some target ranges that we could watch for over the next couple of months. But I want to talk about how this is not just me bashing Bitcoin. Like Ethereum is down here, for example, well over 70% down here still, 71%. The absolute lows here against Bitcoin are 73%. Ethereum is cut in half from more than $4,000 down to $2,000. And no one's batting an eye. No one's getting excited. We're not seeing any major volume wicks here where people are accumulating in a big way, taking upon the discount opportunity. Others' dominance here, which measures the broader altcoin market, still after this huge correction here since back in December from around 12.2% down here to where we are at 8.4%, we are still treating the 21-day as a point of resistance. The 100-month is now acting as resistance here. We can't hold at the 100-month moving average. And this is, mind you, others' dominance is taking into account all those new altcoins that are being made, all those new meme coins, and we're still losing market dominance here. This is really bad looking. And when we kind of zoom out here to the weekly on others' dominance, this to me looks like we're still in a very clear downtrend. The prior low range where we saw buyers come in exuberantly on that flash crash back in June of 2023 on altcoin dominance, we have now seen that kind of buy-side risk-taking activity is just not showing up. So we have to look for lower levels. And the next level I see here is really, if I'm being honest, is 6%, meaning that others' dominance has probably got another huge chunk to give up out of the market. And you pair that with a correction in Bitcoin, you're talking about a real flush out here, a real flush out of all the froth that exists in the meme coin space, all the stuff that really is still worth billions of dollars that probably is worth practically nothing. This is the brutal reality we got to be awake about, guys, here when it comes to crypto. And this leads us to talking about the big picture here that I think a lot of people are missing. It's the only thing that I think you're going to find on a few channels, our channel included here, and that's the macro perspective. Guys, take a look at what's going on in the S&P 500 here in the last quarter or the last month. You can see very clearly the line we've been talking about, the key thing that we've emphasized, as I say here, it's a kind of crude analogy, we've beaten it like a dead horse here. The markets have been on a tear since back in 2009. From the lower range of the ascending long-term 95-year-long ascending channel up to the exacerbated highs of that channel made up of the roaring 20s and the dot-com bubble. And while some people thought, and we kept open to this possibility, we didn't speak in absolutes, right? That maybe we were breaking through this and we were going to go through some euphoric rally due to AI or monetary debasement, whatever. It's very clear now that this has played as resistance. And we're barely holding support at that 200-day moving average. If we break that, there's a very good chance we're coming down to that 200-week. And that's going to be a more than 1,000-point correction. Percentage terms here, right? 18% downtrend to the 200-week moving average. Now, of course, the 200-week will move up over time. Maybe it won't be so exacerbated. But net overall, that is going to have major ramifications, not just for stocks. It's going to have ramifications for crypto. And another major thing that also is sending worrying signs here, when you just scan through the market, and you're going to start to see these. Take a look at NVIDIA. Down $40 a share from its relative highs at 152. Right? And starting to show very clear signs, trending below the 200-day, 21-day, and other long-term moving averages, acting as resistance when they're retested. We got a long ways to go before we get down to that 100-month or 200-week, which are really the next major key levels of support probably for NVIDIA. And you just zoom out here into the monthly, you start to see the clear similarities here, guys. You don't have to be an ultra bear to believe that NVIDIA can go through a 40, 50, 60% correction, because it's done that before. It went from $34 down here to $10 a share. It went from here at $7 down here to $3. This could be very well a small bump in the road in the grand schemes of a longer-term uptrend. You can love NVIDIA, you can love the AI narrative, but you can also realize when the stock is trading at a pretty ridiculous short-term premium versus its fundamentals and needs to come down into the typical moving averages where people find accumulation opportunities. That's where we want to be buying. That's where we want to be in cash for multiple months and finally have our entry point opportunity. So many people are telling you just buy, passively DCA, and unfortunately you might be averaging it at a much higher price that at the end of the day, what we need to consider with the S&P 500, considering that we are at the higher end of this band, that we may be entering into a lost decade. This is kind of one of the big points I want to bring up here before we dive back into the charts, guys, which is that people believe in this idea, and they preach this constantly, that equities and all assets move up and to the right. And if they're talking about over 30, 50, 100 years, they're absolutely right? Equities tend to move up and to the right, or just over the broad long term. But if you're talking about the next 2, 3, 5, even 10 years, sometimes longer, to speak in absolutes like that is flat out lying. You can have lost decades in equities. We had that here from 2000 here to 2013. From that prior high, equities did not make a new high for over 13 years. For 10 years here in the 70s, we did not see a significant new high here in the broader indices or any serious trend formation. And here in the 1920s, in the roaring 20s, we not only saw the stock market pull back from 33 points here in the S&P 500 down here to 4.5, but it did not make a new high for over 25 years. Now, I understand some people believe that, this is so far out, things have changed, it can't be that bad. I'm not even saying it needs to be that bad, guys. I'm just saying that there's a chance, at this point, very good chance, that we're going to touch those long-term moving averages before we see the wiggle room to have an uptrend. And the market is sending us those signals. It's looking very similar here. Notice how through this entire uptrend, take it to the weekly as a great example. Notice how when we broke out here above the 200-day from May of 2020, here all the way into January 2022, we did not touch that 200-day moving average. Not down here, not up here. Only until we started to struggle at that 200-day did we correct down the 200-week and make a sizable correction. Over 1,000 points, 1,200 points from those prior highs. Same here. We didn't touch the 200-day. We got close sometimes, but we didn't, right? Only back here in October 2023. From that point on, we continue to trend higher. Now we're starting to get comfortable and cozy with those long-term moving averages. That shows to me signs of weakness within price. The typical accumulation moving averages are not playing in favor right now. Now, so far, it's holding up here. I'm not trying to be all doom and gloom, but I'm trying to be very clear here in saying something, guys, which is that we need to be very smart here. We need to adjust our strategies. We need to think outside the box, and we need to be looking everywhere when we're determining how we're going to be investing in financial assets over the next couple of years. We need to be very sharp. We can't think of just doing what worked over the last decade, because if we're going into a paradigm shift here in markets, which happens from time to time, then things that worked yesterday are no longer going to work tomorrow. And that's why, as much as I love crypto, as much as I made life-changing returns on Bitcoin and altcoins, I'm not going to sit here and tell you guys to just keep doing the same thing over and over again. I'm not going to blindly tell you guys and show you guys into buying crypto because I got heavy bags in the space. So many people are unfortunately doing. This is a big thing I want you guys to know about. If you guys haven't already, definitely consider checking out the Dash Report. This is our newsletter here on the channel. Our newsletter, we've been writing it since back in 2018. And I've been doing a 360-degree analysis on crypto, but also stocks, commodities, and Forex markets to bring you guys the best opportunities that I can find. And really being honest as well about when it's time to be in markets and when it's not time to be in markets. Because in these exponential sectors, you do not want to get caught holding the bag. Because while they have some of the best returns out of any asset class, they will have the most diminishing pullbacks, the biggest corrections that could diminish those life-changing returns you made. It can give up those gains as quick as they were made. And because of that, I want you guys to consider subscribing to the newsletter, because this is a place where you can get access to some of our best community members who are sharing their TA, their opportunities they see, but also you get a 25 to 30 page plus report where I'm covering a whole range of different assets, a lot of which are upcoming stock plays and stock narratives that are likely to make multiples over the next couple of years, far beyond what Bitcoin and a lot of altcoins are going to be able to really do, because of the simple fact that the risk paradigm here is shifting and the market is now starting to rotate its liquidity and valuation from prior plays that were market leaders into new ones. I'm going to go ahead and demonstrate some examples of this. Right, you can already see it, as we talked about earlier, in the weakness of NVIDIA. You also see it here in the broader semiconductors. This again looks like it's ready for a broader pullback. But I want to talk about the bigger picture here. Look beyond just NVIDIA as a graphics processing unit maker, one of the biggest GPU makers in the world for the AI narrative. Take a look here at the FANG stocks. One of its biggest bottom to top rallies we have seen in history. These are the big technology companies, Meta or Facebook, Amazon, Netflix, Google, that rode very high and mighty over the last couple of months. Out of those, especially over the last couple of years, since back in October 2022, blew past its prior highs in the summer of 2021 for its biggest expansion yet due to the optimism of AI. These stocks have made massive multiples over the last couple of years, but now are starting to unwind at a pretty rapid pace below towards the 100-day moving average, right? And we are far and extended away from the general accumulation moving averages where we might find some buy-side pressure in the market, right? A 300% move from those lows. If you want to even do top-to-top analysis here, right? Still, a massive 70% expansion, right, from where we were back during the euphoria of the COVID bubble. Is that really a time you want to be longing tech stocks? Or are we perhaps coming at a generational top for these names? Because they focus much more on cost-cutting reduction and much more speculative ambitions in AI versus the concrete revenue models that they built. Subscription services, advertising, the expansion of e-commerce in these new narratives, a lot of them are exhausted. And if we take it here to the S&P 500, if we divide it, the FANG index by the S&P 500, you just see how, again, how exhausted this trend has been. This has been a massive rally here, a secondary wave. We can see here's one, Apple and Microsoft divided by the S&P 500. Another really exclusive chart, one of many that we cover within the Dash report. And you'll find here that Apple and Microsoft have been in a clear downtrend against the S&P 500 since back in November 2023. So these stocks that made prior phenomenal returns, massively outpaced the markets, are now starting to seriously struggle at their 200-week. Notice the change of character, never touching the 200-week since back in 2016. touching it once here, tapping off incredibly strong, continuing to rally, and now we're getting real cozy with that 200 week, showcasing that the market's sitting here wondering, hey, who's going to come in and buy the dip? Any takers? No. Market sell-side pressure is going to clear right through, and it's going to drive these stocks lower. So if the S&P 500 is going to be moving lower over the next couple of months, then what is that going to mean for Apple and Microsoft, which are going to be underperforming? These multi-trillion-dollar companies are going to be facing substantial downside pressure. And you can see it in the individual share price of these companies. Microsoft is already stalled for more than a year now. It is far extended away from that 200 week and very far extended away from the 100-month moving average. And Apple, while it has fared better, has started to go neutral since back in July. And again, far extended away from those long-term moving averages. And this is trillions upon trillions of dollars of equity value that could be diminished within a very short window of time, even irrespective of any changes in the financials. It's just a reduction of the PE multiple, the price people are willing to pay for these stocks as we go into a more fearful, uncertain environment with the tariffs that are going on, with the deficit spending reductions from Doge. Again, whether or not you like these things or not, right? Again, I can get behind some of these things. I like the idea of reduced government expenditures, right? And government waste and fraud being removed. But at the end of the day, this is contractionary. Like, there's no debating that. It doesn't mean that you have to think it's a bad thing. It is certainly a bad thing, though, for financial markets in the short term. It is going to put a dent in growth in the economy. You're cutting spending. It's pretty clear, cut, and dry here. Right? That doesn't mean that the world is ending, but it definitely means that you're going to see a contraction in equities, right? So again, if you guys are interested, you can always check out the Dash report. I won't be pushing any more here for today's video. Just wanted to let you guys know about it. You can get 20% off if you sign up on an annualized basis. We're probably going to be looking at exploring raising the price for the newsletter later down the line and stuff. So if you want to lock in this rate, then you guys can definitely do that and save on the 20% discount to join in. We have a lot of value add in the Dash report, whether it be the mid-month webinars, whether it be our trade alerts, and along with that as well, our exclusive market updates that we do from time to time that cover all these different dynamics. There's a lot of really interesting charts that I want you guys to check out. Some big shifts going on in commodities as well as Chinese stocks versus US stocks. So definitely consider checking it out down below in the description. But I want to come here to the close, guys, because while I'm not here to be all doom and gloom here, right? I like Bitcoin below the 200-day as much as I do when Bitcoin is at all-time highs, much more, in fact. I like buying it at a discount. The main thing I want you guys to keep in mind is that just because Bitcoin is at a discount here, in the same way people tell you passively to buy at the all-time highs, don't listen to those who just tell you, well, Bitcoin's down a little bit, buy the dip, right? You could probably buy at a much better price here over the next couple of weeks and months. And if you want a DCA, that's fine, right? I'm not here to tell you guys I'm a Nostradamus and I know exactly where Bitcoin's going to bottom. But I will say this, don't find yourself completely all in on Bitcoin. Don't fall in love with your positions that much, guys. Don't believe in one singular narrative that much when we're entering into a pretty uncertain period of time in history. Financial history, for that matter, as well. We're entering into a really interesting period of time. And with that, I want you guys to be prepared. I want you guys to have potentially some cash on the sidelines for that buy the dip opportunity. I do believe the number can go up and to the right, but I do understand as well, unlike a lot of traders, unfortunately, who haven't zoomed out enough, who haven't been trading for a long period of time, maybe just been trading the last couple of years, that there are those periods of time when you do not want to be in assets, not just for short-term corrections, but if we really zoom out, a potential lost decade. I'm not here to say that that is absolutely certain. I'm not here to speak in absolutes by any means. Again, no one really knows where we're going over the next 5 or 10 years. But I will tell you this, guys, it is likely painting a picture here as we are at the upper band of the S&P 500 resistance band, that we could very well be in that scenario. Anyone who is riding out that possibility is not giving you the honest truth. So I want you guys to keep that in mind here over the next couple of months as you're embarking on your trading journey. And if you guys, again, are interested in doing more short-term trading, I definitely recommend you guys follow Cassie and Paul on our channel. They've been doing some phenomenal market coverage. People have been really happy with the work they're putting out. And that can help you on more of the short-term trading if that's something that is of interest to you. Because if you are going to be doing that, then you want to make sure you do it smart. And you want to make sure you have proper risk-adjusted strategies that are going to play in your favor and have the guidance of people like Paul and Cassie who have been actually going on doing this for a long time and learned from all of the painful mistakes to really become well-seasoned traders in the market and learn their process that actually helped them to navigate all these opportunities. So that's it for today's video, everyone. I rambled on a good amount here. If you enjoyed it, consider dropping a like. It's a great way to support the channel here and all the content that we put out. And as always, again, you can check out the dashboard down below. It's a great way to support me and support the content here on this channel. Thanks so much, everyone, and I'll see you guys right back here on the next video on Monday. Take care, everyone.